Well, the month of June is over. It's hard to believe that we're halfway through 2019, but we are. And so I wanted to give you a quick update on what happened with the options positions that expired over these past 6 months. If you remember, I did 3 previous videos where I talked about sell option strategies. As I go through this list here, I'll highlight which of those actual stock positions I did a video on, so you can go back and look at them. But I had many more than 3 positions. I just didn't have the time to do a video for everything that I sold. So I want to run through these quickly, and just to give you an idea of the outcome, I'll make sure that either on the screen or in the screen notes, I'll have the actual option listed with its strike price and expiration date, so that you can, if you want to do your own research, go back and look at it through the lens of history. In any case, let me run through these. I do want to start out by saying that my option strategy is not to get rich quick. I never look at get rich quick overnight type schemes. I'm always trying to gradually increase my overall net worth, and particularly when I use option strategies, I'm only trying to pick up a couple extra percent. This is just adding a little bit of yield to positions that I already own in case it's selling a call option, and in case of a put option, it's just trying to get an additional yield on cash money that I already have that's in a money market fund that's bearing a yield for me. So I guess that's a good point, again, that I do cover in the other videos, but I want to stress here, I'm not in risky option strategies. I'm simply doing covered calls and cash secured puts. And that's what I want to review with you here today. So the first options contract that I sold earlier this year, I'll go through the calls first, and then I'll talk about the puts. So there were 3 call positions in the first half of this year that I sold. The first one was with Disney. I sold that back in February. This is just when the market was starting to recover from the downtrend that we saw at the end of 2018. I had owned Disney stock for, I don't remember if it's 18 months, 2 years, something like that. But I was in a position with Disney where I was ready to sell it at any price above $120 is where I wanted to sell the stock. So I had sold a call on Disney at $120. It expired in June. This actually was assigned to me. So this is one of the call positions that I owned where I actually had to give up my stock. So Disney was taken away from me. I collected my premium. I got my sell price above $120, and I was happy with that. I do want to add here, though, that back in February, when I had sold this call option, I had no idea that Disney was going to have the run-up that it did. I see no material difference in what has happened with Disney over the past few months and what we'd known the previous 6 months. So this is a great example of a bird in the hand and 2 in the bush. I was happy to sell Disney at 122-ish, 123. Overall, I made about I think a 22% return on my Disney stock, holding it over the time frame that I did. However, had I not sold that call, I would have made a 40% return on Disney. So would you rather have a bird in the hand or 2 in the bush? In any case, that's the way they go. The other call option that I sold was Walmart. I sold that in April. This is also a call position that I had that was taken away from me. I had held Walmart for about 4 years, and I was happy to get rid of Walmart anywhere above about $102, $103, and so I sold a call for Walmart in April. This was a very short one. It expired in May. I actually didn't think that this would be assigned away from me. I thought it would expire worthless because it was only for a month, and lo and behold, Walmart did get up above that level. Got up about 5% or so above where I thought it would. I wasn't worried about that. I know I can never exactly pick a top. I walked away from Walmart with a very nice capital appreciation over many years, and I was happy with that. The third call position that I had was in Verizon. Again, this is a stock that I've owned for a couple years. I was happy to part with Verizon anywhere above $60 a share. Verizon, that call I sold in April. It expired in June. It was not assigned, so I got to keep the stock and I kept the premium. Those are all my call positions. 2 of the 3 were assigned. And that's actually rare. It's usually, for me, the other way. It's usually 1 out of 3 gets assigned. In this case, it was 2 out of 3. But again, I want to stress here, it doesn't matter. I was prepared to sell those stocks at the strike price. As far as the put positions, again, these are all puts that I sold. None of them were assigned to me, meaning that they all expired worthless, so I never had to take possession of the stocks. And just a quick rundown on, I'm sorry, so I did mention, let me go back to the calls. Disney was one that I made a video on, so if you want to understand why I would do a call strategy to sell, check out the previous Disney video on selling a covered call. Now, as far as the puts, there's, see, 2, 4, 6, 8, there's about 8 of them. And the first one that I did was back in February. This was on an energy ETF, and I did do a video on this one. However, that one does not expire yet. I normally do my put and call contracts where they're fairly short term. You know, one month to 4 months, and generally I like to be in that 2 to 3 month range. I like these to where they can kind of roll over, say 4 times a year. So if you do them every 3 months, it's almost like laddering bonds. You're laddering your puts and calls. So in the case of the energy put, though, the one that I did a video on actually ran through the end of the year, and that had a pretty nice yield on it. I forget what the premium was, but it was pretty attractive. So I ran that one out through the end of the year, but I actually came back in and also sold another put on the energy ETF, and this is XLE. It expired just a few days ago at the end of June, and happy with that one. Again, wasn't assigned, kept the premium. I, in fact, liked that ETF so much, though, that since the price had come down on it, I actually went out and bought the actual ETF for my overall portfolio. So this is an example where you can not only sell calls and puts, but you can also buy the underlying security in a separate trade if you decide to. The second put contract that I sold was in January. That was for Devon Energy. It expired worthless in April. Again, that was a short-term one. I got to keep the full premium with that. Never had to take possession of the stock. Devon is also an example of just recently in the May-June market meltdown that we saw when energy stocks took a big hit. I actually went in and purchased Devon. I did it after Devon had sold some of their land holdings up in Canada. I think that's going to be good for this stock. I think it's perhaps going to position them to be acquired by a larger oil company. So I currently own Devon stock in my regular portfolio, even though earlier in the year I was prepared to sell a call against it. Sell a put against it. The third put that I bought this year was in March. Also, it was Boeing. I did do a video on that one. Definitely check that out. That's a pretty interesting video. That was in light of all the problems that Boeing was having with their software and the 2 plane crashes that were involved with that. That was a risky position. A lot of people told me I was crazy for taking it. Well, it's worked out fine. That expired worthless in June. I got to keep the full premium. Also in March, I sold a put on Facebook. That expired in June, worthless. Got to keep that premium. Freeport McMoran was another stock that I purchased in March. That has expired. Again, worthless. Got to keep the premium on that. The transportation ETF, IYT, I also purchased that in March, and I don't remember if I did a video on that one or not. But that has expired worthless in April. Got to keep the premium on that, and that's an example too of another ETF where I went back in during the downturn in late May, early June, and I went in and actually bought IYT. So even after the put had expired worthless and I got to keep the premium, I liked where the ETF was positioned in terms of pricing. I went in and purchased it. It still is in my overall portfolio. And then finally, the last put that expired worthless in June was on Fedex. That is also a put that I had sold in March, and that stock is still having a lot of trouble. I've thought about rolling that one over, but for now I'm just going to stay clear of Fedex. I think it's going to improve now that we're seeing the trade war easing a little bit. But just again, an example of a stock that was out of favor. I didn't want to buy the stock directly. I sold the put. It expired worthless. I got to keep the premium, and that's what the strategy is all about. On selling these puts, I'd rather not take possession of the stocks, so When they expire worthless, I'm happy with that. As far as the call strategy goes, I can take it or leave it either way. In some cases, I'd rather keep this stock because most of these are dividend-paying stocks. But again, when they get assigned at the strike price that I'm happy with the profit that I have built into it, c'est la vie. You never fall in love with the stock. You only date them. Well, hey, that's my opinion and where I'm at this first half of the year with my options contracts that have expired. Check in from time to time. I'll be updating you with other option positions that I have, as well as holdings in my overall portfolio. For the Wealthsteading podcast, this is John Pugliano, as always, wishing you the very best returns.